Let's take a closer look at the markets right now with Lisa Erickson. She is the head of Public Markets Group at U.S. Bank Wealth Management. Lisa, why don't you weigh in on this debate in terms of what you anticipate, what you think from the Fed and what they should be doing given the economic backdrop?
Well, certainly, I think everybody's focused on the question of really when is the Fed going to move? And they're obviously closer to it than they were a couple of years ago. Certainly, Powell has evinced a lot of desire to have certainty around the path of disinflation before moving. And so really, I think timing remains to be seen. The Fed has indicated that they're data dependent. And so we're just going to continue to be watching. In light of that, we really just see the best positioning right now for investors is really to stay neutral on the U.S. stock market. Certainly, the economy is in a relatively good place with the upside surprises that have taken place. But again, there's been really high expectations for that Fed move. And the job's not done with disinflation. And so we think staying in that middle of the ground place really makes a lot of sense.
Look, I will say the one thing that did give me a little pause in watching that interview was when he basically said, we don't have to get inflation to 2% in order for us to cut rates. Scott Pelley made that assertion that, we need to get inflation back to 2%. And Powell said, no, that's not what we said. And so if anything, maybe that gives you the idea that rate cuts are more likely to come even if we don't hit 2%.
Well, again, certainly he said that he doesn't necessarily have to get to that magic number before moving, and that he can continue to look with his fellow bankers at, again, potentially moving policy, even if, the labor market doesn't go into a big funk. But that being said, again, I think they are looking for continued increase in certainty around where the inflation path is going. And it's exactly hard to say what combination of data will do that. So I think we're, again, all on alert, just looking at what the path will continue to be.
We're about halfway through earnings season. What's your takeaway?
Well, certainly earnings have really come in better than expected. And though the rates are not quite to historical averages, what you've seen generally across the board is we're continuing to get those earnings surprises, as well as actually top line that is better than what was expected coming into the quarter. And so I think really what that's showing you is, again, on the back of the resilience in the consumer, companies are continuing to do as well, with demand being able to be maintained as well as managing their internal cost.
So you're neutral on the fixed income market at this point. Do you like equities just based on the better than expected earnings results and what we're hearing from these companies?
So we're really advocating it. Yeah, we're really advocating a neutral position both in equities and fixed income. Again, just saying with the balance of rewards and risks that we currently see present in the economy, and when you're looking at various market factors, again, just staying at whatever your strategic weight would be, both in stocks as well as fixed income, really makes the most sense right now.
Were you caught off guard by the gains we saw last year in the markets?
Well, certainly you had a lot of resilience last year that was not necessarily expected. I think most investors going into the year, including ourselves, really were a little bit more skeptical about what the path might be on the economy. But again, the consumer has stayed very resilient on the back of a strong labor market. And as we go into 2024, we see some of those same trends continuing, where, again, many of the updated indicators we got last week on the jobs market continues to show that labor continues to support the consumer. But again, we still have those headwinds. The Fed has not yet moved, and we really have a past couple of years of very tough rate increases that could have a lagged impact on that consumer spending. So again, we're really in that more neutral zone, again, seeing that balance of strengths and weaknesses.